Global Liquidity explained how China, Japan, and Europe move crypto. You know what's funny? Everyone treats Bitcoin like it's an American asset. Fed cuts rates, Bitcoin pumps. Fed raises rates, Bitcoin dumps. Simple, right? Except there's a massive blind spot in that logic. See, while you're obsessing over what Jerome Powell had for breakfast, there are three other money printers running at full capacity across the globe, and together they control more liquidity than the United States does. I'm talking about China, Japan, and Europe. These aren't minor players, they're the heavyweight champions of global money supply, and if you're ignoring them, you're trading with one eye closed. Quick reminder before we go further, this is education, not investment advice. Do your own research and never risk what you cannot afford to lose. Ready? Let's break down how the rest of the world actually moves your crypto portfolio. First, let's talk about what global liquidity actually means. When people say global liquidity, they're talking about M2 money supply from the world's major economies combined. That's China, the US, Europe, Japan, basically anywhere that prints significant amounts of money. Think of it like this. Imagine the global financial system is an ocean. When central banks expand their balance sheets and print money, they're adding water to that ocean. When they tighten policy, they're draining water out. And crypto is sitting at the edge of that ocean. When the tide comes in, Bitcoin rises. When it goes out, Bitcoin falls. The critical thing most people miss is that this isn't just about the Federal Reserve anymore. Right now, global M2 is approaching $130 trillion dollars. That's with a T. And here's what matters. China alone makes up 37% of that total. That's nearly 48 trillion dollars in their money supply. The US, Europe, Japan, they're all contributing too. But when you combine them all together and track the aggregate, that's when you see the real picture. Let's break down each player because they're all acting differently right now. Start with China. The People's Bank of China has been trying to stimulate their economy since late 2024. They announced the rate cuts, new lending facilities, even direct support for their stock market. But here's the interesting part. Their M2 growth has been underwhelming. It's sitting around 7% year over year when economists say they need closer to 10% to hit their growth targets. Why does this matter for crypto? Because even though China officially banned crypto trading years ago, Chinese capital still finds ways into the market. When liquidity expands in China, it flows through Hong Kong, Singapore, and the offshore exchanges. The other factor, Chinese investors have limited domestic options right now. The real estate market is struggling. The stock market is volatile. When they look for alternatives, even with restrictions, crypto becomes attractive. Now flip over to Japan. Japan is fascinating because they're doing the exact opposite of what they did for the last decade. For years, the Bank of Japan ran the most aggressive money printing program on earth. Negative interest rates, massive bond buying, unlimited quantitative easing. Then in 2024, everything changed. They raised the rates for the first time in 17 years, not once, but twice. They went from negative territory to 0.25%, and when they did that in July, markets freaked out. The yen strengthened by 8% in 4 days. The Nikkei stock index crashed 18%. Why? Because Japan's been the source of the cheapest money in the world for decades. Investors will borrow yen at basically zero cost and invest it everywhere else. That's the famous carry trade. When Japan started tightening, that trade unwound violently. And guess what got hit? Risk assets, including crypto. But here's the thing, Japan's balance sheet is still massive relative to their GDP. They're not aggressively tightening, they're just slowly normalizing. And that process of unwinding decades of stimulus takes years. So Japan is now a drag on global liquidity instead of a contributor. That's a major shift. Europe's story Europe's story is different again. The European Central Bank spent 2024 cutting rates. They peaked at 4% and have been easing since, but their balance sheet is shrinking fast. The euro system balance sheet dropped from 6.9 trillion euros at the end of 2023 to 6.4 trillion by the end of 2024. That's nearly half a trillion euros gone from the system. Why? Because they stopped reinvesting bonds that matured from their pandemic programs starting January 2025. They're not reinvesting anything at all. That means their balance sheet is running off by about 40 billion euros per month. So you've got this weird situation where the ECB is cutting interest rates, which sounds dovish, but their balance sheet is contracting, which removes actual liquidity from the system. What matters more for crypto? The balance sheet, always the balance sheet. Lower rates might help sentiment, but actual liquidity, real money in the system, not what moves prices. So what happens when you add this all up? China's trying to expand but moving slowly. Japan's unwinding decades of stimulus. Europe's cutting rates but draining liquidity. The net result? Global M2 hit new all-time highs recently, but the rate of change matters more than the level, and that's the key insight. Bitcoin doesn't just respond to how much money exists, it responds to how fast that money supply is growing or shrinking. When, when global M2 was accelerating in 2020 and 2021, Bitcoin went parabolic. When it contracted in 2022 and 2023, Bitcoin got crushed. Now in late 2024 and heading into 2025, we're seeing stabilization and modest growth, not explosive, not contracting, just steady expansion. Research shows Bitcoin has a correlation above 90 with global liquidity when you measure it properly. that's stronger than almost any other asset class, stronger than stocks, way stronger than gold. But here's the lag again. It takes 70 to 110 days for changes in global liquidity to fully show up in Bitcoin's price, about 2 to 3 months. That means what's happening in China, Japan, and Europe right now, you won't see the full impact in crypto until spring of 2025. Here's how you can actually use this. Stop watching crypto prices in isolation. Start tracking global M2 data monthly. You can find this on Macro, on TradingView, on various free resources. Look at the combined M2 from the US, China, Europe, and Japan. That's about 85 to 90% of what matters. Watch for acceleration or deceleration. Is the growth rate speeding up or slowing down? When you see global M2 starting to accelerate, position yourself before the crowd notices. When you see it decelerating, get defensive before the crash happens. This is how institutions think. They're not reacting to Bitcoin's price. They're positioning based on what liquidity conditions will be 3 months from now. One more critical thing. Not all liquidity is created equal. Whether US expands its money supply, that has a different effect than when China does it. Why? Because the dollar is still the global reserve currency. American liquidity flows everywhere instantly. China's liquidity, it's partially trapped inside China's capital controls. It takes longer to reach global markets, same with Europe to some degree. So you need to weight your analysis. $1 trillion of Fed balance sheet expansion matters more for immediate crypto price action than a trillion yuan from the People's Bank of China. But over longer time horizons, they both matter. They all add to that ocean of global liquidity. Here's the bottom line. Bitcoin isn't just riding the Fed wave anymore. It never really was. What we're seeing is a global game with multiple players at the table. China's pumping the brakes while trying to stimulate. Japan's reversing 30 years of money printing. Europe's doing this weird dance where they talk dovish but that hawkish. And all of it, every single move, ripples through the to crypto prices 2 to 3 months later. The traders who win aren't the ones with the best chart patterns. They're the ones who understand that Bitcoin is a liquidity sponge. It absorbs whatever the world's central banks are doing, just with a delay. So while everyone else is panicking over a 5% dip or accelerating a 10% pump, you'll know whether those moves even matter because you'll be looking at what Beijing, Tokyo, and Frankfurt were doing 3 months ago. That's the difference between guessing and knowing. Real quick, which of these three regions do you think has the biggest impact on crypto? China with their capital controls, Japan with their carry trade, or Europe with their balance sheet games? Drop your take in the comments. And look, if you want to actually understand where money is flowing before it shows up in prices, stick around. I break down these global macro shifts every week in plain English so you can actually use this stuff. Catch you in the next video.